Hey everyone, I am back with another dividend stock investing video. I'm going to cover 3 value dividend stocks in the video today. I own one of these stocks, the other 2 I don't own, but they make great comparisons to the stock that I do own. I believe all 3 are in value territory. They're in a sector that no one is talking about right now. And so as a long-term dividend investor who uses dividends to pay bills and will increasingly do so over time, it's important for me to search for value. Now, this is the type of video why you show up, why you come here on PPCE. And so make sure to stick around. I'm going to go through the stocks. I'm going to go through my Excel analysis. I'm going to go through financial statements. This is an in-depth video. If you haven't guessed by now, the 3 stocks I'm going to cover are in the defense space. The one I own is Raytheon Technologies. The other 2 that I want to cover are Lockheed Martin and Northrop Grumman. So get ready, everyone, for a really exciting dividend investing video. Welcome to PPC Ian. This is dividend stock investing for everyone. All right, everyone, before we get started with the video today, just a quick note. Check out the pinned comment below. I have a link to my Patreon, and over on Patreon, I have a lot of exciting things. One of the really exciting things is I just shared my complete dividend stock portfolio with the percentage allocation to each different position. I now own 49 dividend stocks, and I have 6 non-dividend stocks for 55 total stocks that I cover over there on Patreon at the Corner Patron tier. So make sure to check that out. Now, in terms of the video today, I want to start out with some news and some information on Raytheon Technologies, and then I want to get into some Excel analysis, and then at the end, I'm going to get into some financial statement analysis. So as you can see on the screen in front of you right now, this is Raytheon Technologies. This is actually a relatively new company. It used to be United Technologies, but then they spun off OTIS and CARR, which have performed very well, extremely well. I own both of those companies. And then the remaining part of United Technologies, which was the aerospace defense part of the company, merged with Raytheon, becoming Raytheon Technologies. Throughout all of this, a lot of investors forgot about these companies because they were splitting apart and mergers and acquisitions. And I think a lot of analysts at this time don't fully understand what's happening, quite frankly, at Raytheon Technologies. And so I view it as a pocket of opportunity in the overall stock market because I know enough that I'm comfortable placing more capital here. And that's actually what I have been doing. And my patrons actually know that because I'm sharing my stock trades over there on Patreon. And so as you see in front of you right now, Raytheon Technologies just reported their third quarter 2021 results. Well, I guess back in October, but that's relatively recent. But I hear no one talking about this. And what happened is not only did they exceed expectations, but they're repurchasing shares and they increased their 2021 EPS guidance. And so this company is doing really well. They are firing on all cylinders, so to speak, but you don't hear about it anywhere. And as a dividend investor, that's when I start really kind of getting attention on something are these types of cases. And so I want to go through a few more news items with Raytheon before I dig into some of the numbers. And so as you can see in front of you right now, this is a recent press release from Raytheon Technologies. This was just recent on December 7th, but they're basically going to be repurchasing $6 billion in shares. And this is on top of another share repurchase that they had just completed. And so actually in the analysis today, when I look at the statement of cash flows, you're going to start seeing the share repurchase and what it means for their free cash flow and cash flow situation. And so kind of take a note. If you're there at home, you're following along, there's a lot of education and details in the video today. So take a note on that because I will discuss that later and it's an important item to remember. Now, the next thing I want to talk about with Raytheon Technologies is one more press release. As you can see on the screen right now, basically they are refinancing their debt. And so you can see Raytheon Technologies announces pricing for cash tender offers. What's happening here is, my understanding is they're going ahead and retiring some debt, refinancing that debt potentially. And you can see a lot of these notes are at really high interest rates, like over 6%. One of them, they're over 7%. It's 7.5%. So you have some higher interest rate debt, and it'll be interesting over time to see what Raytheon does with this. But to me, this seems like they're just refinancing debt and figuring out their debt stack, so to speak. Now, before I even get into the recent financial analysis and where the stock is right now, let's just look at Raytheon Technologies and see how the company has performed over time. I have a screenshot I want to share with all of you from their 2020 annual report. Annual reports are always a really great place to search for such data. So as you can see on the screen in front of you right now, I have a overview, a 5-year summary of 2016 through 2020, and this is from the annual report. This isn't all of the financial metrics, but it's a lot of the financial metrics that the management team at Raytheon wanted to share with all of us. And so, as you can see, the net sales are increasing like clockwork each and every year. 2016 was $28.5 billion, 2017 $29.7, 2018 $34.7, 2019 $45.3, 2020 $56.5. Now, of course, I expect that the sales would jump and be strong around these recent years like 2020 because of what happened with Raytheon Technologies and the restructuring of the company and merging with United Technologies with Raytheon, spinning off OTIS and CARR. And quite frankly, that's why you see there's a net income or loss from continuing operations there in 2020. And you can see on a diluted earnings per share, it's negative there in 2020. 2020 is an anomaly. There's a lot of restructuring that was happening that year. But if you look leading up to 2020 and even including 2020, the sales are going up and to the right. Here, I guess up and to the left because the years are in the reverse order. But you can also even see there, if you go down to the diluted earnings per share, generally speaking, it's moving in the right direction. Now, it does jump around each year a little bit. 2016 was stronger than 2017 and 18, but then 2019 really surged. 2020 is an anomaly. In general, I like what I'm seeing. I see things moving in the right direction. And you can also see capital expenditures is listed here. I'm really happy about that because this is an important cash flow metric that is not included in net earnings. And you can see there that it is generally staying in a range. It hasn't been surging too crazy on any given year. You can also see they show the dividends there, but keep in mind that the dividends are up and to the right, but in 2020 they're down. The only reason it's down in 2020 is they spun off OTIS and CARR, which also pay dividends. And so they lost those two businesses. Well, didn't lose them. They spun them off and they've just flourished as standalone companies, which I still own. But anyways, that's why the dividends are down in that particular year. Now, one thing I would want to talk about here, at the top of this chart, what we're really looking at, the top of the table, is income statement data. At the bottom where it says at year end, this is more looking at balance sheet data. And one of the things I really want to be cognizant of here is you see total equity and it's up and to the right, or I guess on this chart again up and to the left because it's in reverse chronological order. But keep in mind that take note of this if you're following along at home. The equity can be a little misleading because there's a ton of goodwill in there, and goodwill is basically if they pay over book value for an acquisition, that's the difference, and that's how it's accounted for in the balance sheet. I think the equity overstates honestly how much equity this company has, but keep that in mind. Take note there. And you can see that the debt over time has gone up, but that being said, it's somewhat manageable. And quite frankly, it's nice in 2020 seeing that it actually dipped from 2019 and 2018. So they're doing something right with the way that they're managing debt and how they probably partitioned out some debt to the spinoffs as well. Although the total assets at the bottom, again, it ties into equity, I believe that could be a little misleading, and we'll see that as we dig into the numbers later. One of the important things about the video today as a dividend investor, I don't just go put money in a company that sounds good. I don't just go out there and be, hey, I like this business, I'm going to put money into it. Certainly that's part of it. I have to have some kind of interest in a business to research it at all. But quite frankly, what really matters is the in-depth financial analysis. That's what tells me if I'm doing the right things with my money or the wrong things. And so with this background on Raytheon Technologies, what I want to do next is I want to get into an Excel analysis comparing Raytheon to Lockheed Martin to Northrop Grumman, so you can start seeing what's kind of playing out in real time right now with the actual stocks. Before I do that, though, please go ahead, if you enjoy this video, if you enjoy my videos here on PPCE, and to please go ahead and smash the like button. It's really one of the best ways that this video can get to more people out there on the internet. And I want to make sure for that, because this is a channel about empowering the average everyday person to take control of their finances and to automate some of their income through the miracle of dividends. If you enjoy the video as well, please also go ahead and subscribe. It means the world to me. And don't forget to click the notification bell so you get alerted each time I have a new video. I have so many more on the way. I spend a lot of time developing these videos, and I hope you all enjoy them at home. All right, everyone. So with all of that, let's look at the Excel analysis. As you can see in front of you right now, this is something I prepared last night. I was up really late working on all of these numbers for you so that you can enjoy the video today. And what you see is I'm comparing Raytheon, Lockheed, and Northrop. These are three defense and aerospace companies. Now, what I would say, and I didn't back this up with data, but my understanding, and one of the reasons I like Raytheon for myself personally is, and we'll actually go into some of the data on them later, but they have a combination of a defense business, but also just a commercial business as well. And so they're more of a diversified company, whereas I'd have to look at Lockheed and Northrop as how their revenue is diversified between defense and just kind of commercial businesses. But long story short, I don't like reliance on a single customer, the government, for example. And so I like that Raytheon's business is diversified. And so anyway, Raytheon right now, as you can see on the chart all the way at the bottom, it did dip. But again, the reason it tanked there is the spinoff of OTIS and CARR. So it's not that the company is underperforming or anything. It's just literally they spun off two companies from their prior business that really have just flourished. I love owning OTIS and CARR. Anyway, analyst estimates this year are 422, 503 next year, so it places the PE at a 20 this year, a 17 next year. I highlight the 17 because, quite frankly, in the market we're in right now, I think that's a really good price for Raytheon, and I think one of the reasons it's trading at such a low PE right now is, one, it seems this entire sector just trades at lower PEs, but I would say also, I believe that with Raytheon in particular, because of the spinoffs, because of the merger, analysts don't fully understand how to price it. And when they can't fully price it, big institutional money has more difficulty kind of determining what it's worth, and that can create opportunity for the everyday investor like myself who's willing to take on a little risk. With I have enough data to make decisions, but not enough to know with certainty exactly how it's all going to play out. That'll take a few more years of consistent data as a new company. Now, this particular company now is paying 51 cents a quarter or $2.04 a year in dividends, or a starting yield of 2.37%. Now, that's not very high, and I don't have that much data to look at compound annual growth rate, but the last dividend increase, the first dividend increase they made as a standalone new company, Raytheon Technologies, was 7.4%, which is solid. Payout ratio only 48%. Market cap is the biggest of the bunch, so this is a big company in the space, and it's 6.7% off the 52-week high. It's 33% off the 52-week low, so it has surged quite a bit from the 52-week low. Now, one thing I would say about Raytheon that I don't like as much, and this is based on the last 9 months from their recent Q3 report, but the net margins are pretty low at 6.7%. Let's see how that plays out, though. I think they're still figuring out a lot of stuff as a new standalone company without OTIS and CARR, and with the old United Tech, with Raytheon, there's a lot that they're still figuring out, and I read in one of their reports they're still cutting a lot of costs. I think net margins will expand. And again, I think this is one reason it's a value, is they're a company in transition. Now, long-term liabilities, are 51 billion, and their true equity is negative. Actually, the true shareholders' equity on all three of these is negative. I'm going to get back into that in a minute. But that's Raytheon Technologies. Of the three, that's the one I own. I had subscribers out there asking, Ian, can you cover stocks you don't own? We'd like to see more of that. If you'd like to see more of that, please put a comment below. Share your thoughts in the comments. What do you think about the three stocks I'm covering today? Which one is your favorite? And do you have any other stocks that you'd like to see me cover? Or in general, do you like this concept of me covering new stocks, ones that I don't even own? I kind of like it, and I certainly like it when I have a basis of comparison as well. With all of that, let's look at Lockheed. Check it out on the screen right now. This is the middle column in the spreadsheet. And Lockheed, I have kind of a passion for this company because they bought that Sikorsky brand of helicopters from United Tech a while ago, and I was sad to see that go, quite frankly. Of the bunch, Lockheed is really trading at bargain basement valuation, quite frankly, based on the numbers at least. It's trading at $344, but based on the analyst estimates this year and next, it places the PE at a 15 in this year, 13 next year. Perhaps it trades at a discount to Raytheon because they are more focused on defense and government contracts, and so it may be that this particular company has perhaps a little bit more dependency on a single source of revenue per se than Raytheon. That being said, in this kind of market, when I see a PE of 13 for a world-class company like this, it gets me really excited. I also get excited with a starting yield of 3.25%, a 5-year dividend compound annual growth rate of 9%, a payout ratio of 49.8%, so there's more room to grow it. And this one is actually not so far off the 52-week low, only 8%. It's down 13 from the 52-week high. Net margins are the highest of the bunch at 10.4%. The long-term liabilities are not too bad at $30.7 billion. And true stockholders' equity, when I take out goodwill and non-tangible assets, is negative. We'll look at that a bit more later in the presentation today. Now, I have a stock chart for these guys as well. You can see there for many years it has been up and to the right. And so this is a company that has performed really well for dividend investors. Put in the comments below, everyone, what do you think about Lockheed? Is that a stock you own? Do you like that stock? I'd love to hear. Based on this particular analysis, it's looking to me pretty good. Now, before I go on to Northrop, I will say, quite frankly, I'm kind of tied to Raytheon because I already own it. And do I really want to pick up too many positions in the portfolio? I already own 49 dividend stocks. As I mentioned earlier, I shared with my patrons recently, the Corner Patrons, 6 non-dividend. Do I need to pick up another defense sector stock? Probably not. I'm just going to stick with my Raytheon Technologies. But I would say with the 3 I'm presenting today, you could probably flip a coin based on what I know so far. They all have their own unique merits, and I wouldn't say one is necessarily better than the other. It's just that each would fit a different, unique investor. I tend to like Raytheon Technologies because of the diversified portfolio of customers that they have. But quite frankly, Lockheed is showing a lot of value as well. And Northrop is showing something completely different, which I want to show with you right now. So check it out on the screen in front of you. Northrop is such an interesting company, trading at $371. Based on those forward analyst estimates, they're at a PE of 14. Though this company is not growing EPS quite as quick, according to analysts at least, 2022 is going to be pretty similar to 2021. Now, the starting dividend yield is really low at 1.69%, but the 5-year dividend compound annual growth rate is 11.8%. And so Northrop could be a really interesting company for someone who has more time on their sides and is looking really for some really rapid dividend growth. And so that's what's so special about these guys. And that payout ratio of only 24.5% leaves a lot of room for them to grow that dividend. And what I also like about these guys is their market cap is only $58 billion. So it's just a smaller company, maybe more room to grow potentially over time. They are off the 52-week low quite a bit. They're only 9% off the 52-week high. I like the net margins that they're kind of in the middle. They're not as good as Lockheed's, but they're up there at 8.7%. I like that their long-term liabilities are the lowest of the bunch, but that would make sense because the company is doing a smaller scale than Lockheed and Raytheon. It's the smallest of the bunch. Now, what I would say with Northrop on the chart, and I think this is really important for anyone who invests in dividends for the long term, needs to see. Many years it went nowhere. And then all of a sudden it started surging. And you can see, honestly, Lockheed at a similar trajectory, but maybe a little more up and to the right in those early years. And maybe the upward ascendancy of Lockheed started a little earlier. Well, it's hard to tell, I guess, because the time there on the axis is a little bit different. But I guess really Northrop goes back further, and so it's easier just to see, wow, it took a while for shareholders to get any kind of capital appreciation. Now, if you look all the way back at Raytheon Technologies, it has been up and to the right for some time. And so it just goes to show that as a dividend investor, quite frankly, it's important to remember some patience. I've seen a lot of this on the internet recently in the various social media forums where folks are saying, oh, this stock, it's down, it's a loser, or it's not going anywhere, it's a loser. I'm going to sell this. I have to cut it from the team because it's not going anywhere. What I would say is companies, just like people, just like anything in life, go through chapters, go through cycles, go through evolution, and it takes time. I have found as a successful dividend investor, because I've been doing this for a long time, well over 20 years, it makes sense to have a long-term approach. And sometimes companies will have an off year. Sometimes it will be a really long pipeline to develop a particular product that all of a sudden takes off. The key is to do your research, to have conviction, to have enough conviction to hold something even when it's down or even when it's going nowhere for a long time like Northrop did, because you will reap the rewards, the benefits of that over time. As you can see that Northrop's price action, it happened all of a sudden in just a number of years. And so investing, it's all about the long term, and it's important to have a long-term perspective. But oftentimes a lot of the gains, they come into short run, but you can only really realize those short run gains if you have the patience and the perspective to stick with something over the long run, even on times when it's flat or down. And I see a lot of dividend investors missing that concept these days. And so I just want to share it with the community. And it's a skill I've built over the years. I haven't always been that way, but it's something that I've had the luxury of developing over time. And as dividend investors, we all continue to improve and grow over time. And so with all of that, I've compared the three. My takeaway from this analysis is they're all good for kind of different use cases, but I think all three are really good companies. That's what I would say as a long-term dividend stock investor. Now, I will put in the caveat there, as people have brought this up in the community before, that they might have some kind of reservations investing in this industry. Just like the sin stocks that I cover sometimes, some people are more socially conscious investors and they have issue with that particular industry. I would just say at home, exercise your own logic and your own thought. Only invest in the companies that you want to invest in. And so some people might not be as comfortable investing in this industry. Others may be really comfortable investing in it. It just depends who you are as an investor and where you're at. And I've even found on that socially conscious topic that I've kind of been all over the board over the years. And some of you who've been watching me a long time have seen that evolution. I've kind of gone from one perspective to the other, back and forth, and it just happens. And so we all evolve as investors and our thinking evolves over time. And so with all of that, let's dig into some financial analysis now on Raytheon Technologies. So as you can see on the screen right now, there's a few things that I want to share with you. The first one is just their earnings report. I already shared this earlier, but what I like to do sometimes when they do these earnings reports is just put in my own analysis there as well. So one thing I just want to show and highlight is this backlog analysis. One of the things that's just fascinating, and this covers not only Raytheon, but also Lockheed and Northrop too. I saw similar backlogs that they had. These guys have backlogs of 156.1 billion. If I take the backlog and I divide by the revenue that they're doing annually right now, it seems that they have a backlog of about 2.4 years. So the next 2.4 years of revenue are already booked. That's pretty interesting. That's pretty interesting for any company. Now, what I would say that I am putting on here as well is in my analysis, I found that commercial aerospace is 58% of the business at Raytheon, so more than half. Defense is 42%. And so that's that diversification I was talking about. Now, at the bottom here, you can see they give an outlook for the full year of 2021. And so I just start putting some numbers here, and I put in the 2020 numbers so we could do a comparison, and we can see versus 2020, revenue is going to skyrocket in 2021 by 14.7%. Again, does this like a company that should be trading at the PE ratio range that it's at, not based on that kind of revenue growth. If you look at adjusted EPS, and you can see here the 2020 EPS I'm listing here is not negative. That's because it's the adjusted one. There was something wacky going on with the GAAP one. Anyway, that's going to be up 52%. And so wonderful to see. And you can see free cash flow as well. I compare it year over year, is going from 4.3 billion to 4.75. Now, for my 2021 numbers that you see here, I'm taking the midpoint of the guidance range. I'm not taking the high point or the low point. I'm taking the midpoint. And so I thought that was so fascinating to just take this earnings release, put it into a little more perspective. So that's kind of something at home when you're analyzing dividend stocks or any company. You can paste these things into Excel, and then you can do your own calculations right next to them. I want to get into some more financial analysis with Raytheon Technologies. So as you can see on the screen right now in the next slide, I want to go through cash flow really quickly. And what you can see here on the cash flow statement, this is really important. So we have net cash flows from operating activities. What I'm putting here in this column is the 2021 9 months ended. So again, this isn't the full year. This is the 9 months, but it's 3.9 billion. Now, you have capital expenditures. It's important to keep in mind that capital expenditures are not part of net income that's reported. This is basically upgrading facilities, buying equipment, upgrading, their machinery that produces their products. All of those kind of capital expenditures are not there. So I get free cash flow by taking that operating cash flow, subtracting out the CapEx of approximately $2.8 billion. Now, one thing that's really important to notice towards the bottom is we got dividends paid on common stock of just about 2.2 billion. If I subtract that out after dividends for these 9 months ended September 30th, I get a cash flow left over of about 589 million. Now you can see though they have repurchase of common stock of another $2 billion. And so it's really important to understand that, because if I subtract that out, now after they're basically repurchasing that common stock, they get a negative cash flow there. Now, the caveat is this is only 9 months, and so I don't know how they're going to schedule out the stock repurchases for the future, but we know, again, all the way from the beginning of the presentation that they earmarked another, I think, 6 billion of stock repurchases. What I would say right now is they're repurchasing stock in a way that I don't like. They're actually going and kind of going negative cash flow to do that, if you will. And so that's something really important to keep in mind, that for any kind of company, when you're looking at stock repurchases, we want that to happen organically, not necessarily through going out and taking out more debt. Now, the fact of the matter, though, here is I'm only looking at 9 months. And when we look at the full year, when that is available in the future, maybe things will balance out a little bit more. But if there's one red flag I saw so far with this one, is it's really these repurchases of stock. Should that really be happening right now? I'm not so certain. And so that's something to keep in mind for all of us Raytheon Technologies shareholders. I want to move into some more stuff. So as you can see on the screen right now in front of you, check it out. I've got basically their balance sheet. Now, this is going to be difficult to see. Now, if you're a Corner patron, by the way, I'm going to upload my Excel analysis over there on Patreon as well, just some other benefits of being there on Patreon. And by the way, Patreon really supports everything I do here on YouTube. That's why I keep mentioning it. It's really fundamental to the community, and I'm really grateful for the support I have over there. Now, check it out on the balance sheet. We have goodwill, and we have intangible assets. This is what I was talking about earlier, of about $92 billion. So they're saying, hey, we've got all these assets of 158 billion, but quite frankly, of that 158 billion, 92 billion is intangibles and goodwill. And again, goodwill is the difference between what they're paying over book value when they make an acquisition. That's how it's carried on the balance sheet. And so what I would say is, if you go down to the total liabilities of 85 billion, yeah, they're saying they have a positive equity. They're saying 72 billion positive equity. But what I would say is their equity is actually like a negative 19 billion, because 19 billion and change, because what I'm doing is I'm subtracting out goodwill and intangibles. I don't look at that as real assets. Maybe we could carry it for 50% of its value or something, or a lower amount. But quite frankly, if they had to liquidate this business, Would they, you know, get more for it than the book value of their acquisitions? I don't really know. Maybe there would be, because there's a market precedent because of what they paid for it, and we're in a hot market, and of course they're never going to go bankrupt, in my humble opinion. But that being said, I'm just saying the balance sheet appears to be stronger than it is. And so that's something to keep in mind. You know, there's pros and cons with any company. No company is perfect. All companies have a variety of factors to consider. And in summary, what I really like about Raytheon is the diversified business between commercial and defense. I like that the company is increasing revenue sequentially year over year over year, and they have a strong heritage of performing well and creating value for shareholders, not only with their core company, but with the spinoffs like OTIS and CARR. I like that they're increasing the dividend aggressively over time. I like that it's trading at a low PE ratio. I don't see the industry going anywhere. I think the industry will continue to flourish. What I don't like as much about Raytheon Technologies, I would say, is the margins. Net margins are a little low, although I believe that they're probably going to increase those over time. What I don't like as much is they're using potentially debt. They're going kind of negative cash flow to repurchase shares. I don't like that as much. And I would say as well, what I don't like is the balance sheet as much. I'd like them to pay down more debt. And quite frankly, I'd rather see them pay down debt than buy back shares. And so those are some of the negatives. Net, when I look at this company, it is such a world-class company. I would say in general that what I'm criticizing here is fine details, and you will find things with any company that are not perfect. I actually am buying more Raytheon Technologies here, and I found that after it split apart and all the M&A activity happened, I kind of lost focus with it. So it's only recently that I started buying it again, and I'm buying it again because I want to get it in my top 10 solidly, and I want to go ahead and just add to something that's a reasonable PE ratio in this overall market. All right, everyone, I hope you enjoyed the video today. Please go ahead and smash the like button if you enjoyed the video. Again, that is how this video reaches more people, and that's how I'm able to do more videos here on YouTube. Please also go ahead and click that subscribe button. It means the world to me. Now, before I go today, I will, and by the way, I will see you in the comments, so make sure to head down to the comments in a minute and type up your thoughts on these companies and others. I just want to share, though, on the closing of the video today, some disclosures and disclaimers. So in terms of full disclosure, I do own the companies mentioned today, or not all of them, but I own Raytheon Technologies, ticker RTX. I own OTIS, ticker OTIS, and CARR, CARR. I own all three in my personal dividend stock portfolio. In terms of a disclaimer, today's video is not investment advice. I'm not a licensed investment advisor. Today's video, it's just for your fun and entertainment. If you're going to go out and invest in the stock market, please consult your licensed financial advisor first. I'm just sharing my journey here on YouTube for fun and entertainment. It's possible to lose a ton of money in the stock market. It's very risky. And so I'm just sharing my journey here for all of you for fun and entertainment. Don't forget, I have a pinned comment below with a lot of cool links in there, including some social media links like Twitter, where I share some cool stuff. And again, my Patreon, all kinds of goodies over there. I love you all. Thank you for watching today. I'll see you in the next video.